Good morning, good afternoon, good evening, wherever you are. Welcome to another WingRiders Spaces. Hi guys, I can see Indigo, Coty, and Lace Wallet are here. Mehan, yep, there you are. A brief introduction.
So my name is Alexander Panasenko. I'm the Director of Product Management at Kadi. Just a few sentences about Kadi. So Kadi is basically a layer one operator that is built on top of the DAC protocol. And we specialize in enterprise solutions, basically integrating enterprise companies and using blockchain technology as the infrastructure for blockchain payments. And we are also the operator of the JED over collateralized stablecoin on the Cardano network.
Fantastic. Thank you, Alexander. Let's move to Matthew.
Hi, thanks. Yeah, I'm Matt Ploman. I'm the founder of the Mihin project. We are building stablecoins on Cardano. We're building a fiat-backed stablecoin that's built in the design of USDC, where we go throughout the US and get licensed at the various states and have straight fiat convertible USD on, USD off stablecoins. And so right now we're in the building phase, I guess. We've put together a very robust design that has a variety of different aspects to it, and we're building. We're due to launch here in call it 2 months probably.
Fantastic, thank you for that. Alex from Lace.
Yeah, hi there. So I'm Alex. I'm the head of product for Lace. As some of you hopefully know, Lace has recently launched to mainnet. We've got quite a nice reception. If you haven't tried it yet, obviously please download Lace and give us some feedback. There's a long road ahead of us. There's lots of cool features already, but more is coming. And we're hoping to take everybody on the journey to decentralization. Excited to be here.
Fantastic. Thank you, Alex. I know you're short for time. You're leaving a little bit early. You have other appointments, but thank you for making the time here. And last but not least, Indigo.
Hey guys, yep. My name is Daniel Short. I'm the marketing manager of Indigo Labs. Indigo Protocol, which we released back November 22nd of 2022. We're now second in TVL on Cardano, and IUSD is our largest of three iAssets, iETH, iBTC, and IUSD. And yeah, we're really excited to be here. Very grateful for all the other stablecoins coming to Cardano. In our opinion, the more the merrier. And especially we were happy to see when JED launched to have the ability to have a stable swap on WingRiders. So we're very excited for the future. We have a lot to come in regards to plans for IUSD, such as changes within the protocol to help make the stablecoin even more capital efficient and even possibly redeemable in the future, depending on our development timelines. But we're very excited for IUSD and some of the other stablecoins that are all building on Cardano here. In my opinion, this is an exciting time for Cardano. One of the most exciting times we've had in probably since smart contracts launched. Everything seems to be falling in place, and DeFi on Cardano seems to be finally getting a relatively firm foundation.
Fantastic. Thank you, Dan. Yeah, absolutely. Exciting times. And you mentioned the stable swap. So WingRiders is also very excited to have IUSD and obviously JED coming on board. We were able to make the face sort of stable swap pools there, sort of like a curve on Cardano, if you like, for the uninitiated. But yeah, very, very exciting times. And I'm actually going to come back to Indigo anyway. You got your hands up, and it'd be fantastic for you to kick off and talk about really kind of what kind of stable coin does your project offer? What are the benefits? What are the limitations, etc.? And I'll start off with yourself. You got your hands up as well there, Dan.
So IUSD is an over-collateralized stablecoin, soft pegged to USDC, USDT, and TUSD. So we track the median value of those three stablecoins. And what that means is essentially it introduces a level of redundancy. So let's say, for instance, one of those three stablecoins lost its peg. Indigo Protocol would still be able to utilize the two remaining pegs for IUSD to stay consistent. As far as the level of over collateralization that IUSD has, it's actually dependent on DAO vote. So Indigo is unique in the fact that IUSD is completely controlled by the DAO. So a lot of the parameters, and such as the collateralization ratio, can all be changed and modified by the community. So it's extremely decentralized. As far as the labs, it's relatively hands off. Indigo Protocol is very much DAO owned, or DAO ran, you could say. And yeah, I mean that's essentially the simple breakdown. In regards to how liquidations function for IUSD, let's say if someone opens a over collateralized debt position on Indigo, what that means is they'll deposit ADA collateral to mint IUSD at 120% collateral ratio. So stability pools help keep the system solvent by liquidating positions where the ADA collateral value goes under that 120% ratio. So the stability pool takes care of the solvency, and the peg is relying on that triple peg to USD, USDT, and TUSD that I mentioned before.
Fantastic. That's a very simple and understandable explanation of that. Let's go to Mehan.
Thanks. Yeah, I do appreciate the time to explain. So, USDM, Mehan, is following the same regulatory path as Circle did when they launched the USDC token. By law, it is a redeemable form of payment. So this is regulated by the states, the individual states in the US. So we've gone through and submitted applications to a number of different states to be able to operate legally. We have bank accounts at a variety of US banks, and the bank accounts, we've given API access to our bank accounts in a read fashion to the oracles that are operating on Cardano. And the oracles then will publish a token value, or a bank account value, to the chain. And then that value is read by the minting contract that mints or burns the token, such that the total amount outstanding is never in excess of the bank account's balance. So it's a third-party verification, a little bit like what you would see from USDC or USDT when they provide their attestations, but they provide attestations on a monthly basis, and we will provide it with every minting transaction. So it's a little more transparent, a little more secure than those are. Of course, it is fiat convertible. So essentially, from a user interface or a user experience, you would send in fiat, in a bank transfer or in a wire or an ACH to Mehan. We would receive that and mint the tokens and send them to your self-custody wallet. Then once they're in your self-custody wallet, if you wanted to go move about the ecosystem, use them on whichever dexes there are, go through your DeFi things, and then eventually somebody else will have that token, and that person wants to come and redeem it for $1. They would need to come, do a KYC, and then link a bank account, and we would send the $1 back to their bank account that way. So it's a very dollars on, dollars off type stablecoin, not algorithmic like the others, but again, everything has their drawbacks and their benefits. So we would like to fit our part of the ecosystem there.
Thank you very much, Matthew, for that. So yes, a fiat-backed and obviously on-chain kind of verifiable in terms of reserves, is from what I understand. That's fantastic. Thank you very much. Koti, Jed.
So Jed is over-collateralized stablecoin by definition. Belongs to the collateralized segment of stablecoins. So I think its main advantage, it's decentralized, trustless nature that is governmented by the smart contract itself. Just a quick recap on the entire thing of the over-collateralization. So the way that the JET smart contract is built, that basically in order to mint To mint JED, there should be up to between 400 to 800% of reserves in the smart contract in order to mint new JED. So the way the mechanism works is basically that people that wish to provide, participate in the reserve pool of JED, they're able to mint Shen, which is the reserve coin of JED, by basically sending ADA to the smart contract. They gain the reserve coin. It has its own financial incentives. Maybe we'll be able to talk about it, going forward with this Twitter space. But in a nutshell, as soon as you have the reserve, again, 400 to 800% reserved, backed by ADA, you are able to mint JED and use it as a stable coin, basically to pay for commodities and actually hedge yourself against the risks in terms of volatility related to the native tokens in the networks that this stablecoin operates in.
Let's go to Alex. I know you're obviously not a stable coin, but in terms of from a perspective of a wallet, I mean, all the different flavors of stable coins coming. I mean, what are the challenges, I suppose, for a wallet, for instance, to integrate them and support them?
I will probably turn it the other way around and talk about the opportunities there. The wallet is essentially the user interface of the blockchain, right? And as much as ADA is obviously the best cryptocurrency on the planet, there's also the part there that it is a volatile asset, and the good part about any sort of stable coin is it gives the operators and the businesses on Cardano the ability to have predictable expenses and predictable revenue streams that are stable essentially. So from a business perspective, this makes a lot of sense. But from a user perspective, it makes a lot of sense as well, right? We all know the story about the guy that bought like a large pizza and 2 cola for 25,000 Bitcoin, I believe it was. People have learned from that, and nobody at this stage in time would use Cardano to buy a coffee or buy a pizza for that matter, because they know that it's an appreciative asset. They would use stable coins for that. So from a wallet perspective, right, on your day-to-day basis, when you're going about your life, using cryptocurrencies in real life are most likely to be enabled by stable coins. So I'm super excited to see all these great projects joining the Cardano ecosystem, and I would be very excited to discover how we can use those stable coins at a point of sale where the end user is actually utilizing these stable currencies. So that would be my thought on the process.
Fantastic. Thank you very much, Alex. And actually, that brings us neatly to sort of from a user's perspective, really, the use cases. So let's just have the question is really kind of what makes your stable coin stand out from the competition, and why should investors or users choose your stable coin over all the other options? And I think we'll go to Alexander from Coty this time to kickstart this question.
That's not a simple, politically correct answer, but I'll give it my best. Each type of stablecoin, while the principle is the same, it's supposed to provide stability. Each one has its pros and cons. And I think for example, our advantages over fiat-backed, stablecoins are the, decentralized nature. That's one. And, basically it's, the entire protocol is operating on a smart contract. The code is auditable, and you trust the smart contract to actually execute what is written in the code, versus sometimes a more opaque approach to managing, stable coins. So that would be one advantage. I think the decentralized nature of our stablecoin. The second point I want to raise is basically the over collateralization of our stablecoin JED, which, as I previously mentioned, in order to mint new JED, we need to have up to between 400 to 800% in the reserve pool. So this kind of ensures that even the most volatile assets, again, it's backed by ADA, right? And prices tend to fluctuate. So this mechanism is basically there to ensure that at any given moment, the smart contract will be able to actually, return $1 worth of ADA to the user who actually minted JET. So that's, I think, the second advantage that we have. The third part, it's actually really hard to build a secure, scalable, trustworthy, stablecoin solution. And it's one thing, that's one challenge. And the second challenge is actually to going and, driving adoption of stablecoins, because, in essence, stablecoins are really nice, and we can have an unlimited amount of stablecoins in theory being generated on the blockchain. But the thing is you also need to have the business plan in order to go and drive the adoption of your stablecoin. So it's nice to have a stable coin, but the next question that rises is basically, okay, what do I do with that stable coin? So I think if the operator of any given stablecoin has the business connections and means and the experience to go and actually say, oh, you know what, you can go and buy a vacation using the stablecoin that we offer. So you also bring the utility for your stablecoins. And I think considering all of those things that I said, we are really well positioned to continue to grow the adoption of JED. And there are actually more plans to bridge JED to other networks. So we are saying, all right, so we issued JED on the Cardano ecosystem. I think we have 45% of the market cap in Cardano when it comes to stablecoins. So why not take this great protocol that we build and actually, scale it and basically move it and offer it on other blockchains, where we'll be able to use our business power in order to bring utilities. And by doing so, we will basically drive the adoption of the stablecoin. And this entire thing will reflect on the shareholders, which provide the collateral for the JET stablecoin. And they will be able to capitalize in terms of the fees, the mint burn fees that go to shareholders, the staking rewards and the farming rewards that can be, basically grabbed. So this kind of sums things up. And I think this is, we have a solid strategy on how we will grow adoption.
Fantastic, Alexander. So obviously, execution through smart contracts and the decentralization and the over-collateralization is really kind of important there. Let's go to Indigo for the same question, really.
So Indigo actually stands out due to having a very low requirement to mint any I asset. This is actually made possible with a very efficient liquidation via the unique nature of our stability pool. So meaning to say that the system actually initiate liquidation process without the need of auctions to maintain the solvency of the protocol. So one of the best part of Indigo is when you mint an I asset, your ADA actually remains with your stake key, and you can select your favorite SPO. So, for example, if you want to participate in ISPO, you can do so while minting a stablecoin on Indigo. So the next portion is that Indigo itself is open source, and anybody can actually go in, take a look at the code, and justify whether this is actually a good protocol to actually put their money with.
Fantastic. Thank you for that explanation. Mehan, Matthew?
Yeah, thanks. So I think that one of the things about each of these protocols that we're discussing today is the utility of, you kind of have to balance centralization versus decentralization, and each of those gets you some benefits. And so with with the fiat-backed stablecoin, with what Mehan is building, we're going what I would call the centralized route, where individuals need to come through us. We will go through and get U.S. regulators will watch all of our activities, and they'll be overseeing everything that we do to make sure that it's compliant with the U.S. laws. And so that's kind of a drag sometimes, but at the same time, you do get additional benefits to that. So as a regulated financial institution, we would be able to issue debit cards that would be linked to the USDM token. And so as you deposit USDM into your account within Mihen, you would be able to then swipe it and spend it using a debit card. So like that kind of off-chain to on-chain functionality is what you get when you go the regulated route. As much of a drawback as that can be sometimes for people who just want to live in decentral land. But again, like the great thing about having on-chain stablecoins is that if you have anything you need to hedge, so there's this kind of classic example of when ADA was $3, individuals were minting all kinds of PFP projects. These 10K projects were launching, and folks were selling out, and they were making $1 million worth of ADA. And then when ADA dropped to $1 or below $1, and then down to where it ended up at around 25 cents, the individuals had their tax bills come due, and the way that U.S. taxes those kinds of transactions is that you would be taxed on the $1 million worth of ADA. So you'd be taxed on $1 million. So you'd have to pay that tax bill, which would be around $40,000. And if you had at the time of mint converted that ADA that you raised on the sale into, Indigo wasn't live, Jed wasn't live, Mian wasn't live during that time, but imagine that it was. If you had a stablecoin in the ecosystem, you could put 30-40% of your mint proceeds into a stablecoin, either through a DEX or through the JED minting mechanisms, and then have that be set aside to pay your taxes when taxes come due. And then to convert, if it's one of the the algorithmic coins, to convert that into US dollars to pay your tax bill, you would have to then convert it to ADA, convert the ADA into dollars, and can then get those dollars into your bank account to go pay the taxes. So there's a little bit of like slippage or transaction fees at every step along that route. And so what I would suggest is that maybe if you wanted to do an off-chain transaction using stablecoins, you would need a fiat-backed stablecoin, be a more efficient route of doing that. So that's kind of where we fit in the ecosystem. But I get it that what we saw back in March when USDC encountered problems at their banks was this inability to mint or burn, inability to convert back to fiat, this expectation that they wouldn't be able to meet all of the coins that were out there. We're no longer backed by one-to-one by dollars. That's the kind of thing you have to watch out for with these fiat-backed stable coins, that they should always be able to be converted to dollars, because the on-chain price is really determined by the ability for somebody to go out there and buy it for 95 cents on a DEX and then give it to the issuer and get $1 back. And so that market mechanism helps with stability. The ability to convert it into a hard dollar is what kind of keeps that price pegged well on chain. And so when you have things like what happened with USDC with Silicon Valley Bank, they had a big problem there. So that's one of the problems that we kind of have second mover advantage to, where we can say, well, we've seen what happens out in the marketplace, we've seen what the risks are, and there's definitely other risks and sort of the second and third order effects of those you can learn from and can manage against. So that's kind of the long and short of fiat backed.
I mean, you touched on something really interesting there, Matthew, and this is on-ramping and off-ramping from sort of, I suppose, crypto into sort of the real money. And that's obviously something that's always been problematic. And we've got a question in a little bit talking about kind of that area as well. It'd be interesting to kind of hear your perspectives on that, because obviously this is a big issue for many sort of, I suppose, users. And this really needs a resolution, and it seems legislation will be one day there. But before we go there, I have a question that really, how do you see stable coins evolving in the future? And, what role do you think, they'll play in the wider financial system? So there's two questions. So it's how do you see them developing in the future? And what do you think the role will be in the wider financial system? I think we'll start off with yourself there, as you just ended there.
I think that if you wanted to zoom out a little bit and say what kinds of dollars are there, And so there's this concept in accounting called cash and cash equivalents. And there are things, cash in your bank account is cash, but there are also things that you can hold on your balance sheet that are cash equivalents. And so those would be considered things like shares of a money market mutual fund, or short dated bonds are sometimes considered cash equivalents by some accounting standards. And so you can go through this kind of mental rabbit hole and say, well, maybe a stablecoin is a cash equivalent that a company can hold on its balance sheet if it's conducting operations on blockchain. And if it's got a worldwide network of vendors and a worldwide network of employees or suppliers that need to be paid in an efficient manner, blockchain is the solution for that. And stablecoins on blockchains like Cardano are going to be that means of payment that can be relied upon as a simple, straightforward conversion into the various hard fiat currencies until broader crypto adoption has made it. So that's kind of like number one. But then also number two is you think about the ways in which those cash equivalents are being used in the marketplace today. So right now, money market mutual fund shares are cash equivalents that are used for pledging collateral for securities lending positions for hedge funds and capital markets operators that use margin lending for shorting purposes. So you can think about it as the DeFi ecosystem grows, the stablecoin would certainly be a reliable store of value when you need to post collateral. It'd be liquid, it'd be easy to convert back into fiat, easy to convert back into ADA if you want to go that route. So there's going to be a whole lot of use cases for it. When you look at what's happened on Ethereum, basically every Ethereum native token transaction on a DEX conducted against a stablecoin, and those values are known versus a stablecoin, which is great. One of the problems that we have with general adoption within Cardano is that as individuals, let's use Meld for an example, because they're not here. If Meld compensates its employees using the Meld token, then the employees are getting paid in a token that's always pegged to ADA, which is that's one kind of level of risk. But then the project is inherently tied to the Cardano blockchain. So not only is the success of the project tied to ADA, but also your compensation, because the Meld token's traded against ADA, is also tied to ADA. So you're doubly exposed. And that's kind of a problem with using your project tokens, or with having these project tokens be traded against against ADA. I'd much rather see a stablecoin project token pair on a DEX like WingRiders, so that you could then really evaluate the true value of the project relative to a stable currency, rather than intertwining the risk and the price action of the ADA and the project token. I'm sure that Indigo faces this exact problem with their token distribution.
Fantastic perspectives there. Thank you there, Matt. And we'll go to Indigo next, actually, for this.
Stablecoin has been very instrumental in the bear market in helping users preserving their capital. Currently, there is also already having cross-border business transactions using stablecoin, mainly in Asia. This is due to the efficiency of crypto transfer. So in the future, having a decentralized stablecoin will actually help to ensure that there is much less failures due to human factor. And also in crypto, having a stablecoin will allow a lot of projects where they can launch using stablecoin. For example, if we have a launch pad that accepts stablecoin, and they can actually predictably know how their roadmap and their pay, like Mehan actually mentioned, is they can actually budget properly for their development. So having a stablecoin will be very critical for crypto development space.
Yeah, that's very interesting from a treasury perspective to keep it very stable, realistically. And, obviously a stable coin maintains its value to the dollar. And that's a very interesting perspective. Thank you for that. And yeah, sorry, Alexander, what's your perspective on this?
Well, I think the guys did a really good job to sum things up, and I think the major points are that, well, first of all, the stable coins are there to hedge against the price volatility of different altcoins and different digital assets. That's one. The second point I would make that basically there is no business that would like to operate with any volatile asset, and they will always prefer to operate with a stable asset. Like even in the classic financial sector, there are still foreign exchange trading floors that the end of the day, if they have a certain exposure to a volatile fiat currency, they would actually go at the end of the trading day and they will actually exchange it for a less volatile, more stable fiat currency. So, those practices, I think, will find themselves also to the blockchain space. And again, as blockchain economy grows, the need for stable coins will grow as well. I think, the major obstacles for adoption at this point is, I think I mentioned it before, is the utilities, right? It's nice to hold a stable coin. It's nice to hedge yourself, but it would be super nice to actually, going and be able to buy a vacation, a car, or just go to the movies, right? So that would be the third point, and I think, yeah, that sums it up. Oh, I want to add the fourth point, which is, I've been a lot on this sort of conversations, and like we are, I know, maybe forgot or just it's flying so under the radar. It's basically central bank digital currencies. So I think that's kind of the wild card that we will need to actually see what happens. For example, what happens tomorrow if the U.S. government issues its own crypto dollar, right? If the European Union has its own crypto euro. So, governments don't like competition. So the question, what will happen with, the market of stable coins and, for example, fiat-backed stable coins, which are recently under regulatory scrutiny, and we need to see how that goes. So there is, still a lot of we don't know, but I think we need to push, continue, and evolve as the space evolves.
I think there's been some very encouraging updates to the regulatory regime. Firstly, last week, the Europeans approved the next kind of step in their regulatory process of getting their crypto asset regulation, the MiCA regulation, put forward. I think you're going to see a lot of entrance into the euro space. I think euro stablecoins are really something that the European banks and the European actors in the formal financial sector have a whole lot of interest in pursuing. The other thing to consider is the House Financial Services Committee is considering a bill that would formalize the regulation for U.S. fiat-backed stablecoins, and it was a fantastic bill that they're considering. There's a few changes that need to be made, but it's broadly a very common sense type approach to regulating fiat-backed stablecoins and helping to open the door, at least giving some kind of official cover to the banking sector so that they can then engage in this sector as well, and so have work with companies like Mihan to enter the blockchain space and to get their kind of toes in the water on the fiat-backed stablecoin front. It's a fantastic opportunity, and if capital markets are going toward blockchain, then eventually there's going to need to be an additional set of actors in the space that will be the new financial infrastructure, and it's going to parallel what we currently see. And what we currently see was developed naturally over the course of years as a result of the market forces that were in place. I think we're going to see similar types of reactions to the human behavior, the human needs for market forces for the exact same reasons in the blockchain space.
Yeah, I mean, that really brings us on, Matt, to the last final question. And it's really about regulatory issues. So, really stablecoins, particularly in relation to issues such as AML, KYC compliance, systematic risk. How's your kind of project addressing these concerns? And what steps are you kind of taking to ensure compliance with relevant regulations to come or developing, etc.? Because this is obviously going to be again, a very important area moving forward, as you pointed out there, Matthew. And I think we'll go to Coty for this one. And I know you dropped off there, Alexander. So it's really kind of asking sort of how's your project dealing with all these compliance issues, and how do you see it shaping in the future?
First of all, I just want to comment that, a lot of people in the space, and, I've been hearing about this a lot, are kind of anti-regulation. And so I think the space definitely need to be regulated. And I think the road to mass adoption is paved through regulation. But, as the joke goes, politicians are really good at two things, and one is doing nothing, and the other one is over exaggerating things. So regulation is definitely a must in blockchain in order to drive future adoption and mass adoption. And in terms of how we handle it, so as the JED operator, we offer a UI that enables users to mint JED and Chen, as I mentioned before. And we're already using KYT, Know Your Transaction tools that are out there in order to basically monitor and actually introduce some of the anti-money laundering regulations that are, imperative and for basically companies that are dealing with financial instruments. So that's what we're doing now. And obviously, we are monitoring the space, right? We are monitoring the regulations. We are following MiCA in Europe. We are looking at the US, which is one of the biggest markets in the world. And I believe all of the projects would like to go to the US, but due to the regulatory uncertainty, a lot of companies and projects are staying outside of the United States. And I really hope in the near future we will see a framework that will basically highlight, the do's and don'ts. And, everyone that would like to tap into the US market would have to follow suit and basically be financially compliant.
Thank you, Alexander. Let's go to Indigo for this one next.
First, I'd just like to agree with Alexander. Me personally, being in the United States, I know that I spend a good hour a day or so catching up on regulatory news, regarding KYC, stablecoins, synthetic assets, all the above. But I do agree that ultimately, especially for the United States, in some of the bigger markets that exist across the world, regulations are going to be required to some extent. Now, there's definitely different routes to go about regulating this industry, and I think that we can see that pretty well, looking at the general strategies that some of the countries or organizations are taking, such as the United States versus the EU, where the EU just released something about 2 weeks ago that is encouraging, I think, for us as an industry to look at how some countries out there are taking a very positive and forward-looking approach. In regards to regulations for KYC, tokens are not KYC AML'd, but rather mainly the users are. And me personally, I think since users engage through wallets, wallets may be an appropriate focus for some level of KYC once it's required. We are aware, at Rare Bloom, we spoke a bit with Italic Prism, and we know that they're developing a wallet level structure which could provide some level of KYC functionality. And when that's available, it could play a serious part in the Cardano ecosystem. But I think that the most important thing that we can do now as projects, pretty much no matter where we are in the world, is just stay very up to date and also have trusted people who are educated on the topic within your circle to help you make educated decisions. For us, Indigo, we've always been very, very cautious about the different moves that we make, and staying true to the correct regulations and guidelines. So that way, not only is the protocol protected, but also the users know that we're putting a serious effort into that. And Indigo, we're not somebody that's entirely against regulation. Again, as Alexander said, I think it's a necessary piece of the puzzle. We just have to find the right way or the right piece to fit the puzzle without making the rest of it break apart. And I think that's what a lot of countries around the world are really working on right now. And I'm hopeful that they can organize together to try to find something that is both cohesive for the industry across the globe, because right now I think cohesiveness is going to be important for the overall success, but is also relevant. Relevant regulation is important. We've seen a lot of irrelevant regulation from time to time that sometimes leaves questions in our head or things yet to be explained as thoroughly as we might want them. But I am, encouraged by the level of detail that some countries are putting out there, and hopeful that over the next year or two, we'll begin to get a lot more clarity around stablecoin regulation, KYC, protocols and governance tokens in general. There's so many different avenues of regulation for this industry. It's quite the beast. But feeling positive for the years to come.
Thank you for that. Yeah, so I mean, staying abreast of obviously all the changes in the regulatory environment is what I'm getting from this is very important. Obviously, as a stablecoin and as probably the ecosystem and for adoption, yeah, definitely, sort of a more compliance might not be the best flavor of the month for most people involved in crypto, but that's really the way it will go. It looks like, and obviously, using systems like Know Your Transaction and Know Your sort of setting up infrastructures within wallets to be able to do that. Very interesting. And did you want to say something, Alexander?
Yeah, I just want to add a small comment. I totally agree with Indigo on the matter. And sometimes there is a confusion when it comes to blockchain. Anonymity. That blockchain by philosophy should be anonymous. And I'm saying that sometimes people confuse anonymity with privacy. I think we are all entitled to our privacy. And as an industry, we are already coming with different solutions in terms of, for example, zero knowledge KYC solutions that can ensure user privacy, while anonymity is not always great, because if you have a totally anonymous system, it kind of creates that gap that is calling for the thief, right? And different bad actors that are able to operate within the space in total anonymity. And this kind of also brings the bad reputation that our industry has. And I think we earned, but we can prove the otherwise and find technological solutions in terms of privacy and regulation. And this in turn will drive the adoption as people will trust the technology, will understand those companies are regulated, and you have an address to go to if something goes wrong. There are different ways to resolve issues. So I think it's definitely something that we will see a lot of coming this year and next year.
Man, I like Alexander. I agree with him.
Excellent. Thank you very much for adding that. And I know we've been on other spaces, and Matt's been there. I know you got a lot of knowledge and opinions about this area. So, what's your perspective there?
Well, it's fun to walk down a road that somebody else has already walked down. So, USDC in the US is regulated on a state-by-state basis by, I want to say, is like 49 states plus 4 territories, if you include US Virgin Islands, Puerto Rico, DC, and Guam. So they have to deal with a huge list of regulators. They have to file reports on a ongoing basis. They have to be held accountable to a number of different legal entities if they're going to do business in those states. And so even though it's an arduous path and a difficult one to have to walk down, it's very time consuming. And if you want to be frank, pretty annoying. I'd be happy for this federal regulation to be done sooner rather than later. But when you have a surefire product that's out there that you can point to when you go to a bank, I would imagine that WingRiders, Indigo, Cody, you guys probably have a nice conversation with your bankers when you get onboarded to explain what your company is and where you've got your money from and how it's going to be spent and what your project is doing, because banks that want to bank crypto are very few. and banks that want to bank crypto and stablecoins are even fewer. And so when we have had our conversations with the banks that we've approached and have started working with, the conversation always starts off with, what's your KYC policy? How do you control, how do you make sure that you're compliant with sanctions regime? How do you make sure you're compliant with anti-money laundering concerns? And how do you enforce those things on the people that you sell your tokens to and the people that you give money to when they come and redeem? And so we've had to come up with a fairly robust compliance policy, and we've had to hire a couple of different vendors to help us manage it. And so like that whole thing is a nice path to walk down when you've got somebody that's already done it. You can say, well, we're doing exactly what USDC has done, or Circle has done with their USDC product. And many of the banks that we've approached are also working with USDC, and so they understand it at an institutional level. But again, like there's a very, very few that truly understand what cryptocurrency is, what blockchain technology is, how it works, and kind of the perils that it could bring to a regulated institution like a bank. So it's helpful to be able to walk down a path that somebody else has trod, and so that's helped, I think, on our development. But again, like the others have said here, if we can get to a place where the regulators are clear about what needs to happen and how we can control for crime, and how we can avoid individuals who should not be accessing the banking systems because they're criminal enterprises or they're on sanctions watch lists or whatever, like those kinds of things, we can certainly do it. Every time that we have a fiat transaction, we have to make sure that it's with a party that we know, and that's not exactly hard. But the trick comes when you have to explain this to a new partner. And so if we have a new bank that say, we'd like to work with you to issue a debit card that'll draw from the stablecoins that are in our possession, and we would like our users to be able to receive this debit card that they can then spend their stablecoin at a cash register in their life. And they the conversation sometimes goes, are you doing crypto? And we say, well, yeah, kind of. We're not making our own crypto. We're doing a stable coin, which it's a native asset that's a tokenized asset, but it's not a blockchain L1 token. And that usually goes right over the heads of whoever you're talking to. So you really need to be able to have the conversations at the right levels of the organizations that you're talking with. And we've been lucky enough to be able to navigate our way through that and have some good and fruitful conversations with the different banks that we engage with.
I mean, that's a very interesting perspective there. It's really kind of a lack of understanding of probably real fi and sort of traditional institutions that we're battling with. And once the brain goes blank, really, of these sort of real fi institutions, it's very hard, as you say, to kind of try and make a case for what you do. And as soon as they hear crypto, probably fines or other things come into their minds. And that is truly a very, very big challenge, I think, for the whole of the crypto industry. And I think that brings us to our last question. If you guys want to add anything before we go to the audience, please just feel free. Just go ahead. And if you want to say anything else or anything we haven't covered, be more than happy to hear that.
I think we shouldn't neglect the cost of financial regulation compliance, because if you look at traditional financial sectors today, companies that are dealing with fintech companies, banks, those financial compliance costs can reach up to between 5 to 10% of the company's yearly revenue, right? So if an organization such as JP Morgan has, I believe, 54,000 employees worldwide, so you can rest assured that about 4,000 of those are working in, regulation and financial compliance matters. So regulation has its costs. That's one. But if we think of a blockchain, right, basically this is the perfect tool for regulation. Again, as long as we keep things private, and there are different solutions to keep things private in terms of when transactions are made on the blockchain, right, you can keep the privacy of both parties. But in a case that, a party is suspected of international terrorism, with the right, court approval, you can basically lift that privacy and you can expose that actor. So again, we shouldn't confuse anonymity with privacy.
It's interesting. I mean, I think crypto is generally held as like the kind of, the dark side. But when you think of like 97% of money is created by private banks by lending it out of thin air, it's amazing how then crypto can be held to account that doing something wrong, stable coins doing something wrong. And money is actually created 3, 4, 5% is created by a central bank, which is sold at inflated prices to a commercial or a retail bank. And then the rest of it is just created out of thin air, really. It's just zeros and ones. And when I go to buy or take out a loan, suddenly that money is created out of nowhere. So
Well, yeah, I totally agree, and I just remember that I wanted to say, like, for example, if bank today, some authority wants to check a bank, right? Is it compliant? Is it acting by the rules? So basically, there is a bunch of people, some of them nice, some of them with guns in some countries, will come to the office and basically we'll tell the bank, okay, so open your books, right? We are going to do forensic accounting in order to see if you behaved or not. And sometimes, as we heard with big banks being fined for different activities that they weren't supposed to conduct, so they kind of, the regulating body are, kind of always finds things in retrospective. And, in blockchain, which is an immutable ledger, right, you can basically do regulation in real time. Again, given the layer of privacy, of course, you can do it in real time, and it's actually more cost efficient to regulate in blockchain versus, in the traditional financial sector, I think.
Really good point there, Alexander. Really good point. Thank you very much to all our speakers. I think we're going to open up to the floor. I think Crypto Bamba, you want to ask a question, so I'm going to bring you on now.
Hey, my question is for Matthew. Can you see a solution for a decentralized on and off ramp for fiat without using a traditional bank as the bridge? So we can sell our stable coins for fiat and then transfer to our wallets as fiat.
That's a good question. I doubt it, just because it would depend on where you are, I guess. If you're in the US, if you're in Europe, if you're in kind of the Western world, then you're probably going to find a more efficient way than to OTC sell your crypto or your stablecoin for cash. You might want to just do the old traditional, like go get a JED, burn the JED, get your ADA back, and then sell the ADA.
Yeah, because you have all these applications on Cardano, like Meld, for example. They're claiming to going to have the ability to on-ramp fiat into their wallets.
Well, Meld's going to be a bank. Like they're going to go straight, like get a bank license in Europe and be a bank.
Yeah, so something like that can be like a decentralized solution. So you don't need to use a traditional bank as a bridge.
I mean, they are a traditional bank.
Oh,
eventually, you need to work with a bank. Just like if you were traveling overseas, you could go to those guys that are in like little booths and change your cash into the local currency. You're going to pay a terrible rate, but they'll do it for you. I'm sure there'll be something like that for crypto.
Yeah, something like that. That's what I was thinking about. Maybe an exchange or something like that.
Thank you, Crypto Bamba. Let's go to Tobias.
Hey, thanks for letting me ask. So I've been following. This is for the Mehen project. So one of the questions I've been considering for a while is so most of the regulated fiat-backed stablecoins right now on chains where the assets aren't native, like on Ethereum, for example, where say US Circle can go into your account and freeze or move your coins because they have that smart contract capability. And that's something that most regulators kind of determined to be required for a stablecoin to be allowed, right? So on Cardano, where most tokens are native, would there be any way for you guys or like USDA to be able to comply with those regulations?
I think that in general, those regulations are more assumed than expressed. And I think that USDC, even though they do have the ability to lock wallets that maybe have been involved in hacks or have been flagged as illicit, I think that that's just something that they prefer to do out of an abundance of caution for where they think the regulations are going to go. Because there really is nothing that I've been able to tell and that our attorneys have been able to tell would require us to lock tokens on chain. However, there is a little bit of a thing where if tokens are used in crimes on chain, and so let's imagine that you go and get some USDM and use it to pay for a hitman, you send it over to the hitman, and then you've got this kind of illicit transaction that's happened, that we could track those tokens around the ecosystem, and then once they come back and hit if they want to be redeemed for fiat, then they would be deemed ineligible. That's kind of an edge case, I suppose, but it's one of those things we need to think about, and having those know your token technologies, like Alexander was talking about earlier, are an important part of having it. There was a little talk a while ago about putting ordinals on Cardano and marking every token with an ordinal, so you could then work with wallet makers and block producing nodes to prevent those specific tokens from being transacted through some kind of a blacklisting protocol. But that hasn't been implemented on Cardano, but it could be with the SIP. But that's kind of an edge case that we'll worry about in the future, I think.
Well, I would like to add that I think there is a little bit of confusion from the regulators' side, because they kind of are used to regulate banks, right? And from their perspective, a bank, if you go, for example, for the FATF regulations, right? So basically, it requires the receiving party of the funds to do its due diligence, to know the client, and under certain thresholds, it needs to do enhanced due diligence and so forth and so forth. So, there was a period of time that they were basically, especially in the US, where my feeling was that they were taking that model of regulation and trying to stick it to blockchain and say, it will fit. It's exactly the same thing. And it's not. So I think in terms of regulations, we need to separate the protocol level and the application level, right? So it's like saying, let's say we have the email transferring protocol SMTP, right? And we would say, oh, we have spam laws, right? So let's go make the protocol itself to write spam filters. It just simply does not, it's not logical. But to going to different email providers and and basically finding those entities that actually create the spam on the application layer, it's much more, it makes more sense. So, if I look at the protocol itself, I would say, so a decentralized solution in essence is basically it's a protocol, right? And if you build a user interface on top of that, and that user interface caters and services users, right? They should be able to, well, not able, if it's a financial instrument, they should provide this envelope of KYC, KYT, and everything that is required by law. So this is kind of my 2 cents.
Fantastic. Thank you very much, Alexander, for that. I can't see any more requests. All that's left is to thank the projects, Indigo, Mehen, Koti, for being here. And of course, Alex, who had to leave a little bit earlier, from Lace Wallet, for making this an amazing spaces. Thank you for the knowledge that you just parted. Thank you for all the people who asked questions and all the people who are listening and who will listen later. Thank you.